One of the things that I think is very important when it comes to home buying and comparing mortgages and shopping for mortgages is understanding what your mortgage payment's going to be. And we have a lot of content on the channel where we talk about how to set a budget and how to make sure that you have that monthly amount that you're comfortable spending nailed down before you commit to a property so that you don't go over and put yourself in a bind. But in order to do that, you also need to know what's going on with your mortgage payment. Like, what's it going to be? What's included? And so in today's video, what we're going to do is we're going to break down your mortgage payment. I'm going to help you understand everything that's in your mortgage payment that you're paying every month and why it's there. So if that interests you, please stay tuned. We'll be right back. All right, well, like I said, we're breaking down mortgage payments today. But before I jump in, please remember to like and subscribe to the channel. It helps us reach more people just like you and make sure that you never miss a single video that we upload. We're going to jump right in. What's in your mortgage payment? Let's crack the code. Let's demystify the mortgage payment today. First up, we're going to use an acronym. This is something that's used across the industry. We're going to use an acronym called PITI. That's PITI. And PITI stands for Principal, Interest, Taxes, and Insurance. So first up, we have principal. So each month, you're going to pay a portion of your principal balance down with every single payment that you make. As you pay that principal down, the balance on your loan reduces, the equity, hopefully, in your home increases. People pretty much know about principal and interest. They're often referred to as the P&I, the principal and interest. They're often looped together. The interest is going to be the interest that you pay on the loan. So principal would be you take the loan amount, you divide it by 360 months if it's a 30-year mortgage. The amount of that monthly payment, that should be pretty close to your principal. But because you are getting a mortgage, you are getting a loan product, there's going to be interest. And so the interest is simply the interest that you are paying every single month. Now, if you want to be sad, look at an amortization schedule. You'll see that mortgages, because they are long-term loans, they are 10, 15, 20, 25, 30 years, most commonly 30, you pay way more in interest up front and in the beginning of the loan than you do towards the end of the loan, because mortgages are kind of front-loaded with interest just due to how long the term is. And so those are the two factors of your payment that a lot of people kind of know. If you were to use an online mortgage calculator, if you were to go to our website and use a mortgage calculator, then you would see your principal and interest. What a lot of people don't know when they're looking at their mortgage payment online, trying to figure out what is this thing and how much am I going to pay, is that there are other factors in that mortgage payment. So the next part of this PITI acronym is taxes. So another part of your mortgage payment is going to be your annual property taxes on the home. Your annual property taxes on the home. So whenever you purchase the house, even if you pay it off, Uncle Sam still gets paid every year. That's your annual property taxes. It's usually generated by your county or your parish, in Louisiana's case, and you're going to pay those taxes every single year. Well, instead of you paying those taxes every single year, if you have an escrow account, which most home buyers do, then you're going to be paying for those taxes in monthly increments so that at the end of the year, the lender is going to cut the check to your property taxes and pay your tax bill so that your home doesn't get foreclosed on by the sheriff. So that's the PI, and now we've just covered the T, which is property taxes. You can go online, you can see your property taxes. If you're interested in a home, you can go online and get an idea of what those property taxes might look like. Finally, we have insurance. Now, there are multiple insurances involved in your mortgage payment. So when you're purchasing a house, if you're looking at what insurances are going to exist, it really depends on the home. For sure, you're going to have two. You're going to have, well, not for sure, but for sure you're going to have one, and that's property insurance. If you're getting a mortgage, the lender is going to require property insurance, homeowners insurance on the property that meets the value of the loan, that's replacement cost coverage, so on and so forth. So that is often going to be rolled into your monthly amount, your monthly payment, if you're escrowing. And again, most people escrow. The second insurance that you may have is private mortgage insurance, otherwise known as PMI. PMI gets a bad rap, but honestly, without PMI, you wouldn't be able to buy a house if you had less than 20% down. So if you put less than 20% down, unless you're a veteran and you're using a VA loan, you're going to have something called private mortgage insurance attached to your loan. And that's going to also be a part of your monthly payment. And depending on the loan program, it could be on there for the life of the loan. That's going to be the case for FHA and USDA loans. Or it could fall off after you reach a certain loan to value, which is 80%. That's going to be on conventional loans. But that's another form of insurance that you're going to have in your mortgage payment that you have to look out for. Finally, you could have other types of insurance. You could have flood insurance, which is another one that is fairly common for us in South Louisiana. And that's going to also be a part of your payment. So if you had a $2,000 a year insurance policy, if you had a $2,000 a year flood insurance policy, and you had $100 a month in PMI or private mortgage insurance, all of that gets rolled into your loan. And let's say it's $2,400 for easy math for me right here on the spot. So if your flood insurance and your house insurance are $2,400 a year, that is $200 a month each, right? I think that's right. I hope that's right. So that's $400 a month plus your $100 a month PMI. That's $500 a month in addition to your mortgage payment that is now going to be required for you to pay every single month. And this is what's used in your debt to income ratio. It's not just the principal and interest, it's the whole payment. And then finally, with some special mentions here, you could see your homeowners association also included in your payment if you have a homeowners association. So if you have HOA dues or something like that, and it's $800 a year, that will also be taken out of your mortgage payment if you have an escrow account. So that's it. There you have it. That is understanding your mortgage payment, breaking it down, demystifying it, whatever you want to do. That's what's going on with your mortgage payment. That's why sometimes if you go online and you just use a mortgage calculator and you don't enter the property taxes, you don't enter the insurance properly, then the payment you get may be different than the payment your lender is coming up with. So if you have any questions about your mortgage payment, or you want to know what your mortgage payment might be, you want to know how much a particular payment may qualify you for, we are happy to answer all of those questions. You can find links in the description, in our About section, to connect with me personally and directly, and we will help you out. We will give you the answers you are looking for. Thank you so much for watching this video. Please like and subscribe to the channel so you never miss a video and we get to reach more people just like you. I'm Channing, and I'll talk to you soon.